I'm going to show you 3 apps that you can start using today to create passive income, and then I'm going to wrap it up with a stock idea that I like for long-term investment. So let's get to it. I'm Russ, and this is my channel, the one and only Stashing Worthy Acorns, where I put $50 into the Stash app, the Worthy Bonds app, and the Acorns app, and I'm sharing the progress every week with you. Before I get to anything, I want to give a huge thank you to my 5 newest subscribers. Shoutouts in the description below. We've got Kevin Henning, Mr. Stockholder, Lars T, Ethan Chase, and Broderick Watts. Thank you guys for your subscriptions. So yeah, it's really important to start investing today, which when I started way back when, I did the minimum. At least I have money in. I've made mistakes along the way, but one of the biggest mistakes was not starting early enough and not putting in as much as I possibly could. I was told to put 10% in, but not where, not how, not with who, not into what. I wasn't given any of that information. So everybody that's watching this today, you have such a leg up. You have all this knowledge right here. So I recently went to see my grandparents, and as I was walking through, I noticed that every stone had a birthday and a death day. So we all know our birthday, we just don't know our death day. So we all have an expiration date. We don't know it, so that means we have a limited amount of time, and that time is getting shorter and shorter. You need to be purposeful with your time, because no matter who you are, you will end up here one day. So let's make some memories, let's make some money, and let's have fun. The S&P has an annualized return of 10% over the history of the market, and I want to show you how powerful it is to start saving today. So even if we look at the 10% and I figure in a conservative 7%, if I take $1 in 40 years at 7% return, which is conservative, that will be worth $14.97, so roughly 15 bucks. Check that out. $1 turns into 15 in 40 years. So the younger you are, the more it will start compounding, the faster it starts compounding. So just start saving today. And you can start saving with one of these 3 apps. Now, I personally have been investing for many years, made a lot of mistakes along the way, but I wanted to run a little experiment with these 3 apps. And the first one up is Stash. Which you can see right here. The lowest of the 3 was Johnson & Johnson. I've picked these 3 companies because they are super strong. It gives me diversification instantly. They all pay a very nice dividend. But Stash is at $182.67 for a total gain of $32.67 for a percentage gain of 21.78. And as I said, the past 2 weeks prior to putting money into Johnson & Johnson, I put money into Apple. Apple just had a 4-for-1 stock split. So that means if you were to own 1 share of Apple at $400, that on August 31st, when they do the split, you will now have 4 shares at $100. But it just goes to show. So back in March, I happened to just start at the bottom of the pandemic selling, and I put money into Apple, as you can see, and I'm already up 49.86% on Apple, which is huge. I've gained $20.97, and that is just beautiful. You can't predict it, which is so important, why I'm always buying. That's one of the things you always need to do, because nobody can predict what the market's going to do. Everybody has opinions, but nobody knows for sure. Nobody knew that it was going to recover this fast, this quick. There could be another leg down, there could not. I don't know, so I'm always putting money in, because I know when I invest into world-class blue chip premium quality companies that pay a solidly growing dividend, that is beautiful for me as a dividend growth investor and somebody who is going to one day live off of the passive income that those stocks and those companies generate. I'm really liking Worthy Bonds. If you don't know, bonds are a good diversification for any portfolio because they don't move with the market. Now, if you are younger, it probably makes more sense to be in the market, but you can't be all in the market. So I found Worthy Bonds by people talking about it on Twitter, and just a great thing, they pay 5% fixed interest daily. Now I have money over at CIT Bank. They pay 0.96% interest monthly. It's an annual rate paid out monthly. Worthy Bonds pays daily. Your money compounds so much faster. Such a great company. I've had the best experience with them. They are very engaging on social media. I had an issue where my bonds weren't repurchasing and they took care of that. So their tech support was great, quick, and on point. And if you're looking for a good diversification, something that's safe and not exposed to the volatility of the stock market, look no further than Worthy Bonds. So Worthy Bonds allocated $50 million worth of bonds to Worthy Peer Capital 1. When they sold out of those, they went to Worthy Peer Capital 2. So I got in on the tail end of Worthy Peer Capital 1, which is why I only have 5 shares at $50.96, but they are still earning me interest. I've earned 96 cents from that. And then in Worthy Peer Capital 2, I have 12 bonds worth $121. I have earned $1, which is 0.016 cents a day. So I'm earning just over a penny and a half a day, but that is compounding every day. The more bonds you add, the quicker it grows, which is why I'm going to show you something very cool. Because CIT Bank was paying me such a low interest rate, I moved half of my emergency fund over to Worthy Bonds. It was $7,000. And check how quickly this interest is compounded. I'm officially in the $1 a day club. Hey! So we have a portfolio value of $7,240 for an overall gain already of $50.83. I am earning 1.0055 a buck a day. My first goal achieved. My next goal, $2 a day. That's right, and then we get to Acorns. So Acorns. Acorns is ETFs. So Acorns is worth $176.59 for an overall dollar gain of $21.50 for a percentage gain of 13.87. There's 3 different levels you can invest in, and I picked the aggressive. I want the most aggressive. So Acorns decided what aggressive was and is putting my money into a basket of ETFs that they chose. So an ETF in and of itself is a basket. So you can see what they allocated my money into right now. And they are the VOO, which is the Vanguard S&P 500 ETF, the IJR, which is BlackRock iShares Core S&P Small Cap ETF, the IXUS, the BlackRock iShares Core MSCI Total International Stock ETF, and the IJH, which is the BlackRock iShares Core S&P Midcap ETF. All of those have expense ratios you pay. My money is paying 2 entities. I'm paying Acorns, that is paying BlackRock and Vanguard to be invested in these ETFs. So the cool thing about all these is that they all pay dividends. And if you want to see what they are in, you can check out this video from last week where I showed exactly what is the top stocks in the VOO index fund. So look at that. I'm getting dividends from both Stash and I'm getting dividends from Acorns. I like Stash better because it's cutting out at least one of the middlemen. So I think this is really cool. We get to see everything going up and to the right, which goes to show you just keep investing. You may have bumps in the road, but over the life of the market, it does have an upward bias up and to the right, as I constantly keep saying like a broken record. All right, so the stock I'm looking at this week that's undervalued is Prudential. Now this is going to be a 2-minute take or less if I can. Last week with Eaton was a little bit long. Check out the video here. But this is just an idea. I'm not telling you to invest in Prudential. I'm just saying, hey, this is something to be aware of. Prudential was founded in 1875. It is an insurance investment management company. They deal with mutual funds, real estate, retirement products. Currently trading at $63.37 a share. They have earnings of $7.27 a share. They have very low debt, which I like to see. The consensus buy rating is $66.83, so it does have 5% potential upside from here based on what the analysts think. The PE is 8.74, which it has a 5-year history of 8.71, so it's right in line with its 5-year history. So the price to earnings ratio has a cool little trick. It basically means that you are paying $8.74 for every $1 of earnings that Prudential produces, and the market average for the entire stock market PE is 16.29. and the sector for financial is 16.13, so it is a bit undervalued compared to the market and to its sector peers. It does have a good dividend yield of 6.94%, which is good for $4.40 a year per share. And I like to look at the free cash flow percentage of the payout ratio, which is currently 33.47%, which is very low and very healthy. I have no concerns about them cutting the dividend, which they have been growing 11 years consecutively. Now, the financial sector has been down for quite some time, almost 12% over the past year. It's still a little bit risky. It may continue to fall a little bit further as a sector. So I love Prudential. I do own it in my personal account, my taxable account, which I do talk about on my Dapper Dividends podcast. And I also hope you follow me at RustyRam78, where I will talk about more stocks like Prudential. And remember, that's not financial advice. None of this is financial advice. This is me just sharing my knowledge and opinions for fun and entertainment. If you do want to invest in the stock market, you need to do your own due diligence, and I highly recommend speaking with a licensed financial advisor. Stick around, check out this next video. If you haven't, please subscribe if you like the value I'm providing for you so you don't miss any more episodes. I'm doing this once a week. You have my commitment. I will be putting out, to the best of my ability, one episode a week, and I will talk to you later.